Picture the same yellow excavator that's been parked on job sites since your grandfather's generation, still the machine an entire industry pictures first when someone says the word bulldozer. Now picture that same machine sitting unsold on a dealer lot in Nairobi, while a cheaper, nearly identical looking excavator with different lettering on the side gets loaded onto a truck instead. Both images are true right now, at the exact same time, inside the exact same company. Caterpillar just closed out the best year in its 100-year history. $67.6 billion in revenue, the highest number the company has ever posted, in a year the company was literally calling its centennial. A record backlog of $51 billion, up $21 billion in a single year. Profit per share hit $19.06, also a record. The stock outperformed the S&P 500 over the previous 5 years. By every metric that shows up on an earnings call, 2025 was the strongest year Caterpillar has ever had. And this is the exact year the company started losing. Not losing money, losing ground in the one place it can least afford to. The yellow machine that helped build more of the modern world than almost any other object on Earth is no longer the automatic first call on a job site in Lagos, or Jakarta, or Lima. It's being outpriced, outshipped, and increasingly out-engineered by a group of Chinese manufacturers that barely registered on anyone's radar 20 years ago. And the ground being lost isn't some minor side market. It's the exact growth markets Caterpillar was counting on to fund its next decade of expansion. So here's the question this video answers. How does a company post the best financial year in its history and still be the one playing defense? The answer starts with understanding exactly how dominant Caterpillar became, because a fall only means something once you understand the height it started from. Keep that number in mind, $67.6 billion. It matters later. In 1925, two rival tractor makers, Holt Manufacturing and CL Best, merged under pressure from bankers who doubted either company could survive the competition alone. The combined company took the name of the tracked vehicle both firms were already building, Caterpillar. What came out of that merger wasn't just a tractor company, it was the start of an industrial identity that would end up defining what heavy machinery looks like on every continent. By the Second World War, Caterpillar bulldozers were clearing airstrips on Pacific islands under fire. After the war, the same machines built the roads, dams and highways of the Reconstruction era across 3 continents. The yellow paint became so synonymous with dependable earth-moving that rival manufacturers spent decades trying to avoid direct comparison to it. Out of a manufacturing base rooted in Peoria, Illinois, Caterpillar grew into the machine of choice for the entire 20th century mining supercycle. The company whose iron sat underneath copper mines in Chile, iron ore pits in Australia, and coal operations across the American West. The company was confident enough in its own trajectory to relocate its headquarters to Chicago in 2017 to court a more global executive presence, then again more recently to Irving, Texas, each move a signal of a company still actively repositioning itself for growth, rather than managing decline. That reputation compounded for a century. Used Caterpillar equipment still commands some of the highest resale values in the entire industry, with 5-year residuals sitting around 84%, well above most competitors. Cat Financial, the company's in-house lending arm, runs a delinquency rate of about 1.47%, a number most consumer lenders would consider fiction. Today, Caterpillar holds roughly 15.9% of the global construction equipment market, more than any other single manufacturer on Earth, built on a dealer network that took rivals decades to even attempt copying. If a story like this is new to you, this channel exists to go past the headline numbers and into the mechanics underneath them. Subscribing costs nothing, and it means you catch the next one before it happens. Because the empire kept compounding right through last year, not just holding its position but actively extending it. Services alone, everything Caterpillar does for a customer after the initial sale, parts, maintenance, digital subscriptions, brought in $24 billion in 2025, on the way to a stated target of $28 billion, a business line that barely existed at this scale a decade ago. The company now runs more than 850,000 connected machines and engines worldwide, up 70% from 2017. Feeding a services business built specifically to smooth out the boom and bust cycle that used to define this industry. That backlog of $51 billion isn't hope. It's confirmed orders already sold and waiting to be built. Caterpillar spent its own 100th anniversary year setting financial records while returning $7.9 billion to shareholders through buybacks and dividends. From the outside, this looked like a company entering its second century stronger than it had ever been. But then something changed. Quietly, in a country most Caterpillar executives had spent 2 decades treating as a customer rather than a threat. For most of Caterpillar's modern history, China was simply a market to sell into. Infrastructure spending, the Belt and Road Initiative, a construction boom that seemed to have no ceiling. As recently as 2022, industry reports still listed Caterpillar as one of just 6 companies, alongside XCMG, SANY, Volvo, Komatsu, and Zoomlion, controlling roughly 85% of the entire Chinese construction equipment market. Caterpillar wasn't just present in China. It was still one of the biggest players inside it. That framing has not aged well. By 2026, the industry's own ranking of the world's top 50 construction machinery manufacturers, known as the Yellow Table, counted 13 Chinese companies on the list. 13 against 6 from the United States, 9 from Japan, and 4 from Germany. So what changed between one report calling Caterpillar a leader inside China and the next one showing 13 Chinese firms outranking almost everyone outside it? The companies Caterpillar used to sell alongside inside China are now the companies chasing it everywhere else on Earth, and total sales revenue across that Yellow Table list hit a record $246.5 billion, up nearly 4% year over year, meaning the pie Caterpillar is competing for got bigger at the exact moment its own slice of it got harder to defend. The scale of that shift shows up cleanly in the export data. China's construction machinery exports hit $60.169 billion in 2025, up 13.8% year over year, with excavator sales inside China alone growing 17%. In the first half of 2026, Chinese excavator exports surged another 33%. From January through October of 2025 alone, cumulative exports reached $48.526 billion, a 12% jump. This is not a company finding a niche. This is an entire national industry scaling into a global one at a pace Western manufacturers took generations to reach. What's driving it is price. But not only price. Chinese manufacturers are shipping equipment 15 to 25% cheaper than Western equivalents, according to procurement industry analysis, while closing the technology gap fast enough that the discount is no longer buying inferior machinery. It's buying a genuine substitute. At the Conexpo trade show in Las Vegas earlier this year, Chinese manufacturers didn't quietly show up in a back hall. XCMG, Liugong, and Zoomlion all displayed full autonomous electric fleets on the main floor, promoting a strategy they call the 5 modernizations, a push toward equipment that is simultaneously high-end, electric, and intelligent. SANY alone filed 246 patent applications in the first half of 2025 targeting low-carbon components. This isn't a group of manufacturers trying to look competitive for the cameras. It's a group of manufacturers trying to out-engineer the market, not just undercut it. We'll come back to that number. First, the part that made this so hard for Caterpillar to defend against. The real weapon wasn't the export invoice, it was where the machines actually got built. Chinese manufacturers stopped treating overseas markets as places to ship finished product and started treating them as places to manufacture. SANY opened a full industrial park in South Africa. XCMG localized assembly lines in both Brazil and Saudi Arabia. Zoomlion opened an aerial work platform plant in Hungary, aimed squarely at European demand, funded partly through convertible bond financing built specifically for export expansion. SANY also built a supply center in Dubai covering 72 countries across the Middle East and Africa, cutting parts delivery times that used to take weeks down to days. Industry analysts have a name for this shift: Localization 2.0. The old model was product export, ship a finished machine and hope the tariff math still works. The new model is capacity export. Build the plant inside the country you're selling into, and the tariff math stops mattering because there's no tariff left to pay. Think of a tariff as a toll booth on a single road into a country. For years, that toll booth was the whole strategy. Slow the trucks down enough at the border and the trucks stop coming. Chinese manufacturers didn't try to argue the toll down. They built a second road that never goes near the booth. Once the factory sits inside the country's own borders, there's no toll left to collect, and the entire strategy Western governments built around that one road quietly stops working. That wasn't the only problem. While Chinese manufacturers were rooting around tariffs, Caterpillar was absorbing them directly, at scale. In 2025, Caterpillar reported $1.7 billion in net incremental tariff headwinds. Operating profit fell 15% to $11.151 billion, down from $13 billion the year before. Operating margin dropped from 20.2% to 16.5% in a single year. By the fourth quarter, gross margin had contracted to 30.3%, down from 36.3% a year earlier, with total costs up nearly 29% year over year, driven largely by higher manufacturing costs tied directly to tariffs. Research and development spending rose 8%, and administrative costs rose 6% on top of that. For 2026, the company is forecasting another $2.6 billion in tariff impact, with $800 million of that landing in the first quarter alone. The pressure wasn't confined to a spreadsheet. In 2025, Caterpillar laid off 120 temporary workers at its Victoria, Texas plant, citing falling sales tied directly to the ongoing trade tensions. Internally, employees began describing a company quietly thinning its ranks through restructuring and stricter return to office mandates rather than announcing layoffs outright. Jim Umpleby, Caterpillar's CEO at the time, had said years earlier, "We've navigated trade tensions in our 94-year history." That confidence was about to be tested by a version of the problem the previous 94 years hadn't prepared the company for. The bigger problem wasn't the tariffs themselves, it was what Chinese manufacturers were doing with the breathing room those tariffs created. They weren't just avoiding the cost. They were using the space to expand into exactly the regions Caterpillar needed for future growth. China's construction machinery exports to Africa grew more than 50% in 2025 alone. SANY's revenue from Africa specifically jumped 55.29%. Zoomlion now generates nearly 60% of its total revenue from overseas markets, with its mining machinery sales abroad more than tripling in a single year. Liu Gong secured a $120 million order for electric equipment in Vietnam. SANY's overseas revenue alone now exceeds 60% of total sales. These are not marginal markets. Emerging economies across Africa, Southeast Asia, and Latin America are exactly where the next wave of infrastructure spending and mining investment tied to copper, lithium, and gold is expected to land, the same regions Caterpillar's own century of dominance was originally built on. The company that once treated these markets as guaranteed territory is now watching a cheaper, faster moving competitor arrive there first. And this is where the story gets stranger. This wasn't supposed to be Caterpillar's exposed flank. Autonomy and advanced technology were supposed to be the moat Chinese competitors couldn't cross for another decade. Caterpillar's Mindstar platform runs more than 800 autonomous haul trucks worldwide and is still considered the industry benchmark. But Zoomlion has already deployed an unmanned mining system, coordinating hundreds of driverless trucks at once. XCMG and SANY have both fielded integrated unmanned excavation and loading systems on live overseas mining and infrastructure projects, while SANY separately demonstrated a driverless heavy truck platform built with the autonomous vehicle company Pony.ai. Chinese electric construction equipment now accounts for roughly 70% of the entire global market. The technology gap that was supposed to buy Caterpillar another 10 years is closing on multiple fronts at once, and faster than almost anyone in the industry predicted. The reckoning arrived quietly, not as a bankruptcy or a lawsuit, but as a changing of the guard. In April 2025, after 8 years as CEO and 45 years at the company, Jim Umpleby stepped back to executive chairman. Joe Creed, a 28-year Caterpillar veteran who had led its energy and transportation division, took over as CEO, later adding the chairman title in April 2026. Umpleby's parting words on the transition were simple: Caterpillar's best days lie ahead. It was a statement of confidence handed to a successor, walking directly into the most serious competitive threat the company had faced in 100 years. Industry analysts tracking Caterpillar closely have started watching a very specific set of numbers as early warning signs. SANY's market share inside the North American mini excavator and mid-size wheel loader categories, a segment Caterpillar has treated as core territory for decades. Cat Financial's delinquency rate, still historically low today, but the first-place broader stress in the contractor segment would show up if it ever came. Neither number has broken yet. Both are being watched precisely because everyone in the industry now assumes they eventually might. Creed inherited a company that is still, by every current measure, the largest in its industry. 15.9% global share, $37.8 billion in construction equipment revenue alone. The best financial year in company history sitting right behind him. But he also inherited a landscape where the thing that used to guarantee that position, being the biggest, the most trusted, the hardest to copy, is no longer enough on its own. Scale used to be Caterpillar's entire argument. Now scale is the one thing China has more of. So what actually happened here? It comes down to three things. First, Caterpillar spent a century building an empire on being the default choice, the safe pick nobody got fired for buying, and defaults only hold as long as nobody offers a genuinely comparable alternative at a meaningfully lower price. Once Chinese manufacturers closed enough of the quality gap, the discount stopped being a risk and started being simple math. And math wins slowly, then all at once. Second, the tariffs built to protect Western manufacturers ended up taxing the Western manufacturer directly, $2.6 billion worth in 2026 alone, while handing its challengers a working blueprint for building around the wall entirely through local factories and local financing. The policy aimed at the competitor landed on the incumbent instead. Third, the technology edge Caterpillar was counting on to buy itself time, autonomy, electrification, artificial intelligence is being matched faster than anyone in Irving, Texas expected it to be. A 10-year head start has a way of looking like a permanent one, right up until the year it doesn't. Creed's answer is a bet that services and technology, not raw machine sales, become Caterpillar's real business going forward. The company is chasing that $28 billion services target, leaning into a new partnership with NVIDIA on physical AI and autonomy, rolling out an internal Cat AI assistant, and even signing deals to supply gigawatts of power generation to AI data centers, a business Chinese construction rivals aren't positioned to touch. It just acquired mining technology firm RPM Global to push further into the one segment, deep pit mining automation, where its lead is still largely intact. Whether that bet closes the gap before Chinese manufacturers finish closing theirs is the question that will define Caterpillar's next decade, the way the merger of two failing tractor companies defined its first.